welcome to your custom deep dive. And, wow, the sources you provided for today, Monday, April 23, 2026, they are painting a really intense picture.
Yeah, intense is probably an understatement at this point.
Right. I mean, just last Friday, we saw the S&P 500 shatter 7,000 for the very first time.
Which is just a historic milestone.
Exactly. And the NASDAQ locked in a 13-day winning streak. Like, we haven't seen a continuous run of sheer market euphoria like that since, what, 1992?
Yep, 1992. It's an artificial intelligence boom that is practically defying financial gravity.
But then, on the exact same day, we have this massive geopolitical shock. U.S. Marines literally blew a hole in the engine room of an Iranian-flagged cargo ship in the Gulf of Oman.
Yeah, the whiplash is it's historic.
So today, our mission is really to explore what happens when you take a 13 million barrel global oil deficit and it collides head-on with the Silicon Valley tech bubble. We're connecting the dots from your sources to map out this macroeconomic collision course.
Because, we're basically looking at a market functioning on a fractured reality right now.
Right, totally.
In one hemisphere, you've got equity traders pricing in this technological utopia. But in the other, you have naval commanders and diplomats staring down a literal ticking clock.
That Wednesday ceasefire deadline.
Exactly. The ceasefire expires this Wednesday at 8:00 p.m. Eastern. And the connective tissue between those two completely different worlds is global energy.
Because tech needs power.
Right. The tech sector's momentum, it just cannot outrun physical, real-world supply chain instability forever.
So let's start with that physical instability.
Mm-hmm.
Because the narrative shifted so violently over the weekend. Like, all of last week, the market was trading on this assumption of a successful ceasefire, right?
Yeah, everybody thought it was a done deal.
We saw all these reports about the Strait of Hormuz reopening to commercial traffic, the U.S. supposedly easing its active blockade, and then bam, the Tuska incident happens and completely derails the peace agreements.
Yeah, the timeline of that naval interception is super critical to understand. Well, break it down for me, because a 6-hour standoff in a contested waterway, firing on an engine room isn't just a warning shot. It's a highly calculated physical intervention. What does that actually look like mechanically?
Well, it's basically an escalation matrix taken to its absolute limit. So the Tuska is this Iranian-flagged cargo vessel, right?
Huh.
And it was intercepted by a U.S. guided missile destroyer. The U.S. Navy is alleging the vessel was attempting to run the active blockade of Iranian ports.
Which is obviously a massive red line.
Right. So standard maritime protocol, it dictates a series of escalating warnings. You start with radio contact, then you move to visual signaling, and then finally, warning shots fired across the bow.
But this went on for 6 hours.
6 hours, yeah.
Yeah.
Which indicates that Tuska just blatantly refused to alter course or even, cut its engines.
Wow, so they were just ignoring the destroyer completely.
Pretty much.
Oh.
So eventually the U.S. commander authorized targeted fire. And they didn't just blast it, they utilized highly specialized munitions aimed directly at the aft lower hull, just to take out the engine block.
Exactly. The goal was to compromise the engine without actually sinking this massive multi-ton vessel.
Right, because sinking it causes a whole different diplomatic disaster.
Right. So once the Tuska was basically dead in the water, U.S. Marines executed a hostile boarding and officially seized the ship.
And obviously, Iran's Revolutionary Guard immediately labeled this an act of piracy.
Oh, instantly.
Which, from a strategic standpoint, it's like trying to finalize a delicate peace treaty while the delegates are actively throwing rocks at each other across the table.
That's a really good way to put it.
I just have to question the timing. Why authorize a kinetic escalation right now, just days before the Wednesday ceasefire expires?
Yeah.
It just seems completely counterproductive if the goal is to normalize the energy market.
Well, so that assumes both sides are actually operating with a unified grand strategy.
Which they aren't.
No, not at all. And the diplomatic situation in Islamabad proves that. The peace talks were originally scheduled for last Thursday in Pakistan. Then they got delayed to the weekend. And now, as we head into Monday, J.D. Vance, the U.S. representative, reportedly hasn't even boarded a plane to start the new round of talks.
So they aren't even in the same room yet.
Exactly. And you can see it in the betting markets. Like, Polymarket odds for a finalized peace deal are just stubbornly stuck below 40%.
Which is really pessimistic. And just to report on the stated positions impartially here, based on the sources, the Trump administration is holding an incredibly hard line.
Very hard.
They've stated they will absolutely not extend the temporary ceasefire. nor will they allow the Strait of Hormuz to resume normal operations without a signed permanent treaty.
Because they're utilizing the blockade as a financial weapon.
Right. The goal is full denuclearization.
Hmm.
And the arithmetic of that financial weapon is just staggering.
It really is.
The active blockade is costing the Iranian government an estimated $500 million per day in lost revenue.
$500 million every single day.
That is a brutal economic burn rate. The U.S. is essentially betting that Iran will bankrupt itself before it walks away from the table.
Yeah, but on the flip side, Iran's public posture is that as long as the blockade persists, the strait remains closed to the rest of the world.
So it's basically an international game of chicken.
Exactly.
Yeah.
Which brings us to the internal factionalism within Tehran, because that severely complicates the whole thing.
You mean regarding who's actually giving the orders?
Right. Remember how you questioned why the escalation happened now?
Yeah.
Well, the Iranian legislative branch, the moderates, they're the ones staring at that $500 million daily deficit.
Right. They see the bank accounts draining.
Yeah, they recognize the blockade is totally unsustainable, so they are the faction actually attempting to negotiate in Islamabad. But, and this is the huge but, they do not control the Iranian Revolutionary Guard.
The IRGC.
Yeah.
The hardliners who are actually out on the water.
Exactly. The same hardliners who intercepted, 24 commercial ships over the weekend? And directed fire at French and British vessels. The IRGC views literally any concession to the U.S. blockade as a fundamental capitulation.
So they're completely at odds with their own government's negotiators.
Yes, and so the terrifying long-tail risk that the market is just now beginning to price in is what happens if a treaty is actually signed on Wednesday?
Wait, you mean if they get a deal, it might actually make things worse?
Well, an official diplomatic agreement doesn't physically disarm the IRGC.
Oh, I see.
If the IRGC views the treaty as illegitimate, they could transition from a state military force into an asymmetric rogue entity.
And that opens up a terrifying Pandora's box when you think about the nuclear material.
Exactly.
Because if the IRGC fractures from the moderate state apparatus, they aren't just going to politely hand over the enriched uranium to international inspectors.
Definitely not.
The intelligence assessments we're tracking in the sources highlight a massive risk of that material being smuggled out of the country through black market channels.
Oh.
We are talking about the potential for localized radiological threats, the so-called suitcase bombs proliferating across the region.
It's a nightmare scenario.
So the risk matrix doesn't just zero out on Wednesday night if they sign a paper. It simply mutates into this longer, darker shadow of asymmetric warfare.
And that shadow falls directly over the global economy's most vulnerable choke point. I mean, the Strait of Hormuz facilitates roughly 20% of the world's total oil consumption.
1/5 of the entire world's oil.
Yeah. When you have rogue elements operating fast attack craft in a waterway like that, the shockwave hits corporate balance sheets instantly.
And we are definitely seeing that shockwave in the data today. Look at WTI crude, the domestic U.S. benchmark. It is just uncomfortably sticky in that $88 to $90 a barrel range right now.
Yeah, it won't budge.
And Brent crude, the international standard, surged over 5% this morning to top $95 a barrel.
Which hurts everyone.
Plus, the European Central Bank released a very sobering projection. Their baseline fear is that a protracted conflict in the Strait will trigger a global deficit of 13 million barrels of oil per day.
13 million. Every day.
So let's translate that massive deficit into actual corporate realities, because the transportation sector is currently taking an absolute beating.
Oh, yeah. Airline stocks are tumbling. United, Delta, American, they're all way down.
But I really want to zero in on Alaska Air Group, because they report their Q1 results soon, and they're basically the perfect microcosm of this crisis.
They really are.
The analyst consensus in your sources expects a massive $1.55 per share loss for Alaska. But to understand why it's that severe, we have to look at the mechanics of the crack spread.
Right, the crack spread,
Right.
which is basically the lifeblood of airline profitability.
Can you explain how that works for us?
Sure. So it represents the pricing differential between a barrel of raw, unrefined crude oil and the refined end products, like jet fuel.
Because airlines don't just pour crude oil into a Boeing 737.
Exactly. They burn highly specialized middle distillates. Now, Alaska Air sources a massive percentage of its jet fuel from refining hubs over in Singapore.
Okay, so they're buying from Asia.
Yes, and because those specific Asian refineries are heavily reliant on sour crude flowing directly out of the Middle East, the disruption in the Strait caused a localized panic over there.
So it's a domino effect.
A huge one. The refining margins in Singapore didn't just tick up a little bit, they exploded by 400%.
400%.
Yeah, they jumped from 45 cents a gallon to $2.25 a gallon.
That is insane. That is a 400% premium just for the refining process itself, completely independent of the underlying 5% surge in the raw crude oil.
Exactly. And the timing for Alaska Air, it is catastrophic.
Oh, because of the merger.
Yes. They are in the final stages of this massive merger with Hawaiian Airlines.
Our mergers are notorious capital incinerators.
They burn so much cash.
You're integrating complex IT infrastructure, you're combining unionized workforces, standardizing fleets. That requires a massive war chest of liquid cash.
But Alaska's current ratio is sitting at a really precarious 0.50 right now.
And for anyone who doesn't look at balance sheets all day, what does that 0.50 actually mean?
It's the canary in the coal mine for liquidity. A current ratio of 0.50 means the company only has 50 cents of liquid assets available for every single dollar of short-term liabilities coming due within the next 12 months.
Oh, wow. So they are extremely tight on cash.
Very tight. So when a company with highly constrained liquidity gets hit with a 400% supply chain shock on their main operating expense fuel, they are forced to tap into expensive, high-interest credit facilities just to keep the planes flying.
Right. They have to borrow money at terrible rates just to operate.
Exactly. And that completely destroys the financial synergy models they presented to their shareholders when they first announced the Hawaiian merger.
So a geopolitical event in the Gulf of Oman instantly breached a domestic corporate balance sheet.
It's all connected.
But, looking at the industrial sector shows us that these energy shocks don't actually impact all players equally.
No, they don't. It really depends on strategy.
Let's contrast two major steel manufacturers reporting earnings today, because I think this is fascinating. We have Cleveland-Cliffs and Steel Dynamics.
Two totally different stories.
Right. Cleveland-Cliffs posted a $229 million GAAP net loss. And on the surface, you see that and think, wow, that looks like a disastrous quarter for American manufacturers.
It looks terrible in the headline.
But when you dig into the footnotes and the sources, that loss was heavily driven by an $80 million one-time spike in energy costs related to severe winter weather.
Yeah, they had to pay exorbitant spot market prices for natural gas just to keep their blast furnaces operational during a freeze.
Which is incredibly expensive.
Very. But if you strip out that localized energy anomaly, Cleveland-Cliffs actually beat their revenue expectations. They brought in $4.9 billion.
And didn't they grow their physical shipments too?
Yeah, they grew their physical steel shipments by 9% year over year.
So the core demand for their product is robust. They simply got crushed by the input costs required to produce it.
Exactly. Now, on the flip side, look at Steel Dynamics. Their shares surged 5% today on the expectation of a staggering 94% increase in earnings per share.
A 94% EPS jump in the same macro environment. I find their pivot fascinating because it is just a masterclass in macroeconomic insulation.
It really is.
They aren't just selling heavy structural steel for skyscrapers anymore. They commissioned a massive state-of-the-art aluminum flat-rolled mill down in Columbus, Mississippi.
Yeah, they're aggressively diversifying.
Right, into the beverage can and automotive aluminum markets.
Mm-hmm.
And those specific supply chains, those demand cycles, they operate completely independently from traditional heavy industry.
Right, buying a soda is different than building a bridge.
Exactly. By altering their metallurgical footprint, they created a pricing buffer against these massive industrial energy shocks.
It proves that strategic operational management can actually override macro-level chaos. I mean, they recognize that the traditional steel market is hypersensitive to global energy prices, and they engineered a way out of that dependency.
Which is brilliant.
Yeah.
But let's follow that thread of energy prices. Because those surging input costs, whether we're talking about the 400% crack spread for Alaska Air or the spot market natural gas for Cleveland-Cliffs blast furnaces, those costs do not just evaporate.
No, somebody has to pay them.
Right. Corporations pass those premiums directly to the consumer, and that is the fundamental mechanism of inflation.
Which brings us to the Fed.
Exactly. The entity tasked with crushing that inflation, the Federal Reserve. And right now, we are in the middle of a monumental transition of power there.
Yeah, Jerome Powell is stepping down in mid-May.
And his nominated successor, Kevin Warsh, faces his Senate Banking Committee confirmation hearing tomorrow.
And he is walking into an absolute firestorm.
Truly. The macro backdrop for this hearing is incredibly hostile. Look at the data. The March Consumer Price Index popped 0.9% month over month. That brings the headline year-over-year inflation rate to 3.3%,
And what's driving that?
a 19% surge in consumer gasoline prices.
Exactly. Energy strikes again.
So Warsh is facing a really tough crowd tomorrow. What does his philosophy actually mean for the average listener's wallet and, the future of interest rates?
Well, he is bringing a very specific traditionalist philosophy to the role. He refers to it as the Fed staying in its lane.
Staying in its lane. Okay.
Yeah. Because, for the past decade or so, the Federal Reserve has operated under a remarkably broad interpretation of its dual mandate.
Right. They've done a lot more than just look at inflation.
Exactly. Beyond simply targeting 2% inflation and maximum employment, the institution has allocated vast resources to researching things like climate change economics.
Okay.
And they've also been adjusting monetary policy to target inclusive employment, basically attempting to guarantee job growth in historically marginalized demographics.
Which sounds like a noble goal, but Warsh disagrees with the Fed doing it.
Warsh wants to completely dismantle that framework.
Wow.
Yes. He argues that climate initiatives and sociological labor targets are fiscal policies, and fiscal policies belong to elected lawmakers in Congress, not unelected central bankers.
So he wants the Fed to operate purely as a technocratic machine, focused almost exclusively on price stability.
Exactly.
But I want to challenge the historical viability of that approach for a second. Because historically, when the Federal Reserve develops tunnel vision on inflation and they ignore the nuance of the broader labor market, they tend to hike interest rates too aggressively, right?
That is the risk, yes.
They fracture the credit markets and trigger unnecessary recessions. So is Warsh walking into a trap of his own making by refusing to look at the broader economic health?
Well, he would argue that without price stability, broader economic health is mathematically impossible anyway.
That's a fair point.
In his prepared remarks for the hearing, he uses a very specific cultural phrase that I found fascinating. He claims that low inflation is the central bank's plot armor.
Plot armor. Like in a movie or a TV show.
Exactly. It protects the Fed from political interference. His theory is that when inflation is low, the average citizen doesn't even think about the Federal Reserve.
True.
And if the citizens don't care, politicians leave the institution alone. But when inflation surges past 3% and gasoline jumps 19%, that plot armor just disintegrates.
Because everyone is furious at the grocery store and the gas pump.
Right. The public demands accountability, and lawmakers start threatening to audit or restructure the central bank.
So Warsh believes the only way to preserve the institution's independence is to ruthlessly crush inflation, even if it requires holding interest rates painfully high and inducing a short-term labor contraction.
Yep. He thinks it's the only way to survive politically.
But the debate over his confirmation tomorrow isn't just about his monetary philosophy, is it?
No, not at all.
It's being completely overshadowed by a very modern political flashpoint, which is his personal exposure to cryptocurrency.
Yeah, his mandatory financial disclosures were quite revealing.
They revealed a massive web of private wealth. Based on the impartial reporting in the sources, Warsh holds investments in at least 20 different crypto-linked entities.
We are looking at companies like Ulith, Lemon Cash, and On Juno.
Which creates this fascinating paradox. We have a nominee who wants the central bank to be ultra-traditional, to stay in its lane, but his personal portfolio is deeply entrenched in the most disruptive, deregulated financial architecture on the planet.
And the political friction that's causing is intense. And it's totally bipartisan, too.
Really, both sides are pushing back.
Oh, yeah. You've got Republican Senator Tom Tillis actively threatening to block the confirmation. He likely views the massive crypto exposure as a huge liability, or at least a conflict of interest regarding any future regulatory frameworks the Fed might issue.
Right, because how can he regulate an industry he's heavily invested in?
Exactly. And simultaneously, Senate Democrats are scrutinizing whether a financier with that level of specific private market wealth can actually operate independently from the Trump administration's broader economic agenda.
So everyone is skeptical.
Yeah. The crypto markets represent an existential threat to traditional central banking authority. Placing an investor in those specific protocols at the head of the Federal Reserve, it creates an unprecedented conflict of interest debate.
Okay, so if we pull back and look at the macro picture we've painted so far, we have inflation reaccelerating due to a 13 million barrel oil deficit.
Check.
We have a potentially hawkish new Fed chair telegraphing that he will keep interest rates elevated to fight that inflation, regardless of the pain it causes the labor market.
Zach.
Under any traditional financial model, the stock market should be in a severe defensive correction right now. People should be panicking.
They absolutely should.
Yet the S&P 500 just crossed 7,000. It is literally defying gravity.
It is.
And the reason for that is one single sector generating an alternate reality: artificial intelligence.
Yes. The earnings data driving this tech rally is just, it's a statistical anomaly.
So.
Well, historically, between January and April, Wall Street analysts revised their first quarter earnings per share estimates downward by an average of about 2%.
Right, they lower expectations so companies can easily beat them.
Exactly. It is a very predictable cycle of expectation management. Corporations lower the bar so they can jump over it during earnings season. But this year, the dynamic has completely inverted.
Yeah.
Analysts have revised their Q1 EPS estimates upward by 4%. The optimism is compounding on itself.
But that optimism is dangerously concentrated, isn't it?
Oh, incredibly concentrated.
According to the data here, the technology sector is projected to generate 67% of the total earnings growth for the entire S&P 500.
Let that sink in. 2/3 of all corporate profit expansion in the United States is coming from one sector.
And it gets even more granular than that. NVIDIA alone is expected to account for 21% of that total index growth.
Just one company.
Yeah, it's like a tug-of-war where you have one massive bodybuilder, tech, dragging the entire opposing team,
Yeah.
while the rest of their own team, like the Dow or equal weight indexes, is actually losing ground.
That's exactly right. We can observe the mechanics of that concentration by looking at the index weightings. The standard S&P 500 is a market capitalization weighted index.
Meaning the bigger the company, the more it influences the index.
Right. So as companies like NVIDIA and Microsoft surge in value, they command a mathematically larger percentage of the whole index.
Which creates a loop, right?
A massive mechanical feedback loop for passive investing. Think about it. Every single time an average investor deposits money into their standard 401k index fund, the algorithm automatically allocates a massive portion of that capital to the top 5 tech stocks.
Simply because they are already the biggest.
Exactly, which drives their prices even higher, completely regardless of their fundamental valuation.
And it really masks the deterioration of the broader economy. If you look at the equal weight S&P 500, which is an index where NVIDIA carries the exact same mathematical influence as, say, an airline or a grocery chain, it's only up 8% since its recent lows. But the standard cap-weighted index is up 12.2%. That 4% spread represents the sheer brute force of the tech megacaps just dragging the rest of the struggling economy across the finish line.
But the thing is, the competition within that tech sector is becoming vicious.
Oh, absolutely. Look at the intraday movements from Monday. Marvell Technology surged 5.8% on rumors they're partnering with Google to architect 2 new custom AI chips.
And the moment Marvell surged, Broadcom's stock dropped 1.6%.
Which is fascinating. We need to understand the hardware mechanics here. Why is a company building custom chips suddenly an existential threat to established players?
Because it represents an evolutionary leap in data center architecture. So the initial phase of the AI boom, it was dominated by generic graphics processing units, GPUs.
Like the ones NVIDIA makes.
Right. And GPUs are excellent at parallel processing, but they are incredibly power-hungry and expensive.
Okay.
So now, massive tech conglomerates like Google and Meta, they're demanding ASICs, application-specific integrated circuits.
ASICs. How are they different from GPUs?
An ASIC is not a general-purpose tool. The algorithms are physically baked into these silicon logic gates at the atomic level.
Wow. So they are hyper-specialized.
Exactly. They are designed to do one highly specific AI task with maximum power efficiency. Historically, Broadcom has absolutely dominated that custom ASIC market for cloud providers.
But now Marvell is stepping in.
Right. Marvell entering that specific arena with a massive Google contract indicates that the capital expenditure pie is fracturing. The hyperscalers are demanding bespoke silicon to protect their margins.
And, the relentless pursuit of those margins has a pretty dark side for the labor force. We call it the efficiency paradox.
Oh, yeah. Meta is the perfect example of this.
Right. Meta Platforms is at the absolute bleeding edge of this AI infrastructure rollout. Their valuation is near record highs, yet they just announced they are laying off an additional 8,000 employees.
Which seems deeply counterintuitive.
Right, for a booming company to authorize mass terminations.
But it is the ultimate manifestation of the technology they are actually building. Meta is generating massive revenue premiums by selling the promise of AI-driven efficiency to their enterprise clients.
Right, they're saying, buy our AI, you'll need fewer workers.
Exactly. And internally, they are deploying those exact same large language models to automate their own operational architecture.
Oh, so they're eating their own cooking.
They are using AI to write code, manage logistics, and streamline human resources. They are aggressively slashing their human headcount to expand their profit margins.
So they're effectively weaponizing their own product against their workforce.
Yes, the technology generating the wealth is mathematically designed to eliminate the labor required to build it.
That is heavy. And it brings us perfectly to the critical data releases scheduled for the week ahead. Because while AI might be driving the headline index numbers, the true foundation of the U.S. economy has always been consumer spending. This week's earnings slate is the ultimate reality check to see if everyday buyers are actually surviving this inflationary squeeze we've been talking about. Let's start with Wednesday's major wildcard, Tesla.
Tesla is going to be super interesting this week.
Yeah, the stock actually reversed early gains on Monday to close down over 2%. And we know from the sources they suffered a brutal first quarter. They only delivered 358,000 vehicles against a Wall Street consensus expectation of 365,000.
A pretty significant miss.
Right. So with physical car sales actually contracting, what metrics are institutional investors actually hunting for on Wednesday's earnings call? What are they hoping Elon Musk says?
Well, the institutional narrative around Tesla has completely detached from automotive manufacturing at this point.
Really? They're a car company.
I know, but if you value Tesla strictly on vehicle delivery margins, the math looks really grim right now.
Fair enough.
So the market is pivoting. They're starting to value Tesla as a decentralized energy grid and an AI robotics firm.
Okay, break that down.
First, consider their Megapack and energy storage division. That division quietly generated $3.84 billion in the fourth quarter alone.
Wow, almost $4 billion just on batteries.
Right. As the global energy infrastructure becomes more volatile, which is ironically exacerbated by the exact Middle Eastern conflicts we discussed earlier, utility-scale battery storage and grid arbitrage become incredibly lucrative.
That makes total sense.
Yeah.
And the second component?
The AI compute expenditure.
Right.
Wall Street is heavily focused on the capital burn rate for their autonomous driving infrastructure.
The robo-taxi narrative.
Exactly. Investors want to know exactly how many billions of dollars Elon Musk is sinking into the data centers required to train their full self-driving neural nets.
They want confirmation that the pivot is real.
Right, because they are pricing the stock based on high-margin software multiples, not the low margins of bending metal to make cars.
Meanwhile, the traditional consumer is fighting a very, very different battle in the grocery aisle.
Oh, yes, they are.
And the Department of Justice is stepping in. They are preparing to file an aggressive antitrust lawsuit against Cal-Maine Foods and several other major agricultural producers.
Over eggs?
Over eggs, which have been the absolute poster child for household inflation. I mean, every consumer feels the impact when a standard carton of eggs spikes from $2 to $5.
It's the most visible inflation there is.
So the DOJ Antitrust Division is alleging sophisticated algorithmic price coordination. Walk me through the mechanics of this, because they aren't just like meeting in a smoky back room to fix prices anymore, are they?
No, the modern antitrust landscape is way more subtle. It focuses on shared information services.
Okay.
The DOJ is alleging that these massive agricultural conglomerates utilize third-party data aggregation software, and they used it to continuously benchmark their pricing and supply metrics against their competitors in real time.
So everyone can see what everyone else is charging and producing.
Right. By sharing highly granular, forward-looking production data through a centralized hub, they effectively achieved algorithmic price fixing without ever having a direct illegal conversation.
Wow. That is wild.
It is, and it signals a highly aggressive pivot by the government. They are trying to combat inflation through direct litigation at the corporate level, attacking the supply chain directly, rather than just waiting around for the Federal Reserve to adjust interest rates.
And we're going to get a massive pulse check on that everyday consumer on Tuesday with the release of the March retail sales data.
That data drop is going to be crucial.
The consensus expectation points to a robust 1.3% increase in retail sales, which at first glance implies the American consumer is resilient, right? Like they're absorbing higher prices and continuing to spend.
You really have to be careful with that assumption. You have to separate the nominal data from the real economic output.
How do you mean?
Well, the 1.3% retail sales figure is nominal. It does not adjust for inflation. So, if a consumer spends $100 on groceries in February, and then the exact same basket of goods costs $110 in March, Retail sales mathematically show a 10% growth rate.
But they didn't actually buy anything extra.
Exactly. The consumer didn't purchase more volume. The currency simply degraded in purchasing power.
So they're spending more just to survive.
Right. I urge anyone analyzing Tuesday's data to contextualize it against that 32% year-to-date surge in gasoline prices we talked about.
That's huge.
That 1.3% growth headline is almost certainly a mirage. It's swollen by the unavoidable cost of just filling up your gas tank to commute to work. It actually masks a highly probable contraction in the true volume of physical goods flowing through the economy.
It is basically an illusion of growth, which perfectly mirrors the structural cracks we are seeing appear elsewhere in the market. I mean, look at Boeing. They're expected to report a catastrophic loss this week as they face severe production halts and FAA quality audits.
Things are really bad there.
And look at United Health, which is actually observing shrinkage in their insurance memberships.
Right.
Beneath the shiny veneer of this NVIDIA-led S&P 500, the foundational pillars of the traditional economy are really buckling under the weight of sustained inflation and geopolitical shocks.
Which forces us to kind of synthesize the massive amount of disparate data we've covered in today's deep dive.
Yeah, let's pull it all together.
We are observing a macroeconomic collision course in real time. The financial markets are stretched to their absolute historical valuation limits by the sheer gravitational pull of artificial intelligence optimism.
But that entire superstructure rests on a deeply fragile physical foundation.
A foundation that is currently held hostage by a ticking clock in the Strait of Hormuz.
Exactly. The margin between a glorious AI-driven economic boom and a devastating 13 million barrel global energy deficit. It all comes down to the unpredictable internal political fractures of the Iranian Revolutionary Guard and a Wednesday night ceasefire deadline.
It is a breathtaking level of tension.
It really is. And it leaves me with one final provocative thought that really connects the absolute extremes of our conversation today. From the custom silicon AI chips in California to the oil tankers burning in the Gulf of Oman.
Lay it on me.
We have spent this entire deep dive analyzing two parallel narratives, right?
Yeah.
First, the incredible infrastructure demands of the AI revolution, which requires these multi-billion-dollar data centers running specialized ASICs 247.
Yep.
And second, the severe vulnerability of the global physical energy supply chain. So my question to you, as you look at all these sources, is this.
Yeah.
What happens when those two tracks inevitably cross?
The physical bottleneck of computation.
Exactly.
Right.
What happens to this unstoppable market-carrying AI boom when the tech giants suddenly realize that their massive, power-hungry data centers are completely reliant on the exact same fragile, physical, global energy grid that is currently being targeted by geopolitical blockades?
That's the million-dollar question.
You can build the most advanced neural networks in human history, but you cannot run them on code alone. They require an uninterrupted fire hose of electricity. So, can artificial intelligence outsmart a physical energy crisis?
I guess we're going to find out.
That is the question I want to leave you with today. Thank you for joining us on this custom deep dive into your sources. The world is moving fast, the data is complex, and we encourage you to keep exploring, keep questioning, and keep looking beyond the headlines.
Because the true market signals are always found in how the pieces connect.
We will see you next time.